Well, hello folks, Richard Reyes, the Financial Quarterback, and welcome to another episode of Financial QB TV. Today we're going to talk about 401k advice you should definitely ignore. Now, of course, I've always told you that there is no shortage of personal financial advice out there, and it always seems like the guy in the cubicle next to you is the resident expert in 401ks. And because of the open enrollment periods that we've had in the last couple of months, and because we're going into 2010, you've probably had to make some decisions going forward in your 401k. So I thought that I would bring you these 401k advice that you often hear, but that you should very well ignore. And the first one is you should make sure that you move all of your money into Fund X, which is always followed by the sentence, "It's been doing very good lately." Well, that's nice, but what reason do you have to believe that that fund will continue to outperform in the future? If there's one thing you can be certain about, is that the future won't look exactly like the past. The next one is you should stop contributing into your 401k until the market recovers. Folks, in the last year, the market has recovered. Okay, if you've noticed something from the beginning of the year till now, the market has had a very decent bounce back. The foolishness of this statement is obvious. The best time to buy is precisely when others are not, and the others are leaving. That is when the market is at the lowest level. So don't panic when you have temporary 401k losses. That is the time to put more money in and also to continue contributing. Now the next one is obviously something that is recently in fashion, which is buy gold, buy gold, buy gold. And there's always somebody in the office that will be telling you why, in his infinite wisdom, everybody should be buying gold. While I don't deny that commodities have a place in the long-term portfolios, you certainly don't want to put all of your contributions or even most of your 401k contributions into gold or commodities if they are offered in the platform. If you want to hear more of my take on gold, make sure to watch my video, Keep Your Bling Around Your Neck. The next one is stocks are too risky. Well, of course they're risky. If they weren't risky, they wouldn't be giving you the long-term generous returns and they have done in the past. But you know what the biggest risk is? Not having enough money accumulated. So if you don't want to invest in the market, well then go ahead and put all your money into the bonds or stable value funds provided inside of your platform, and then good luck retiring on the pittance you'll have in your account. Now the next one is diversification is for losers. Folks, I have heard of this so much during the last year. It's even been written up in magazines and Wall Street Journal. Folks, this is obviously stupid. But the goal of investing is to maximize the odds of achieving satisfactory results, not making a fortune overnight. Diversification is a major component of that goal. And last but not least, 401ks are a scam. Folks, 401ks are not a scam. Over long periods of time, a diversified portfolio of stocks, bonds, and real estate will generate reasonable returns in excess of inflation the vast majority of time. Okay? Is your 401k guaranteed to outpace inflation over long periods of time? Well, of course not. But you know what? Nothing is. Okay? However, the chances of failure are infinitesimally small. So guys, remember, we're helping you create wealth, ignore Wall Street, and get on with your life. See you next episode of Financial QB TV.